In this episode, we're talking about why you need to have a long-term approach with your investing.
Thank you everyone for tuning in today. Today's episode's talking a little bit about investing during times of political uncertainty. And is this something that you should be doing, or is it something that you should be avoiding altogether?
Yeah, it's a good topic because we're talking about timing the market, and there's so many people that try to time the market out there, especially with the news that's going on today around trade wars and tariffs. There's a lot of people that are fearing what's going on and trying to make the right call based on what they think is going to happen. So really topical to take a look at it.
Geopolitical uncertainty can often cause investors to feel anxious around their investments. So you typically see a lot more volatility during political uncertainty. But if you really look at the history of the markets in the long term, these types of political events often have no long-term effects as it relates to market values.
Sure, yeah, absolutely. I mean, that's why it's so difficult for people to invest into them, because it is really a short-term thing that makes them freak out. So when we have, wars or things like that break out, it can cause short-term volatility, which human nature says we want to run away from pain. And so when we feel that pain, we try to go away from it. And in reality, the best thing to do in investing is to try to control that human behavior and control and make disciplined decisions around it. So, I mean, there's lots of examples throughout history that we can look at, and I think that's a good idea. We should look at them.
So today we're going to walk you through some political events that occurred in the past and give you an idea of what happened with the markets after those events.
I think one of the major events that we should look at, which has happened over the last just over a century ago, would be in World War I. I mean, if you look at the year 1914, the Dow Jones Industrial Average actually dropped down by 30% that year. So it was a significant drop. And in fact, because liquidity dried up so much, they ended up shutting down the market for 6 months.
6 whole months.
Yeah, so a completely unprecedented situation. Yet if you look at what happened to the market over the next few years, as you were saying earlier, the market actually rose by 88% in the following year.
Yeah.
And then it was up 44% over the following, in total, over the following years.
Yeah. So from 1914 to 1918, it returned an average of 8.7% a year.
Yeah, exactly. So if you actually looked at it and you didn't try to time the market around a really bad thing happening, you ended up making lots of money over the course of the 4 years that the World War I was going on.
Grant, how about we talk a little bit about the Cuban Missile Crisis that had the world on the brink of nuclear war?
Yeah, I mean, actually, for some of our clients, you might even remember that time. You were probably little then, but you remember what was going on then, which was really what's really astonishing about it is that the market was really calm during the 2-week period that the Cuban Missile Crisis was going on. It actually only dropped by 1.2%. I mean, that's like a daily fluctuation that we can see sometimes in the stock market. So, I mean, really, it was flat during the 2-week period. And then over the course of the remainder of that year after the crisis ended, the market was actually up 10%. So, I mean, again, if you try to time it out thinking that this is a really bad situation, I'm going to sell off, you missed out on really 10% of growth in your stock portfolio.
The next example, Grant, we go back to a day that ingrained in everyone's minds, 2001, September 11th.
Yeah.
Planes fly into the World Trade Center buildings.
Yeah, I think everybody, I remember where I was. I mean, it was picture day in high school, actually, grade 12 for me. Again, it's a situation that obviously tragic, but caused a short-term fluctuation in the market to the downside, where it dropped by around 15% over the following 2 weeks, essentially. And
the market was already in some pain due to the technology bubble.
Yeah, we were in recession already at that point in the U.S. in any case after the technology bubble burst, as you said. So the market was down 15% over that 2-week period of time. But if you look at actually over the next couple months, the market completely recovered again and was back to being positive. So again, it's a short-term fluctuation, tragic situation, but short-term for the markets. And within a couple months, you're already back to being positive. And had you tried to time that out, again, you probably lost quite a bit of money on that.
Last example, always a good example when we're talking about market pullbacks and remaining calm and investor behavior.
Yeah.
2008 subprime mortgage crisis. Tell us a little bit about that.
Well, I mean, that's the one that's still in the back of everybody's mind. I think everybody has reset their risk tolerance based on what happened in 2008. Anybody that was investing at the time anyway. And so, of course, as we know, the markets were dropping. Depending on which market you're looking at, you're down 30 to 40%. And so really a difficult year for everybody. But again, if you tried to escape from the market and if you tried to just go to cash for a number of years until things started looking good again, you would have missed out on one of the best market rises in history. And
typically the best market rises, if you look throughout history, often occur right after the significant bad periods.
Absolutely. So if you tried to avoid the pain, is what we're saying, you would have missed out on one of the biggest increases in history. And in fact, with even a couple of years, the markets were up 23% or just above 23%. So again, you can't make short-term decisions around these things, because if you're buying when everything looks rosy, frankly, you've missed out on the best growth that you're going to see.
We're not trying to say markets won't be affected by these political events. What we're trying to say, or the point that we're trying to make, is that markets often have their biggest gains after the dust settles from these negative events.
Yeah, and I think that's exactly the point we're trying to make. We know the markets are going to have short-term fluctuations. That happens all the time. But what we're trying to say is if you have a disciplined approach around when you buy and sell investments, that you're going to end up far better off than trying to predict what's going to happen in
Absolutely.
the future. Because nobody can do that. And if you look at the best investors in the world, they don't try to do that, so neither should you. So I think with that, let's close it off. Thanks very much for joining us again. To send us questions, please visit our website at www.whitehoustonwealth.com and stay tuned for more episodes. Ready?
Aim.
Fire.